Let me ask you something simple. Do you know exactly how much money Centrelink thinks you are earning from your bank account right now? Not what you are actually earning, not what your bank statement says, but what Centrelink has decided you are earning, the number they are using to calculate your senior pension every single fortnight, because there is a very good chance that number is significantly higher than reality. And that gap between what your savings are actually earning and what Centrelink assumes they are earning could be quietly taking hundreds or even thousands of dollars out of your pension every single year. And most Australian retirees have absolutely no idea it is happening. I want to tell you about a man named Robert, 76 years old, former tradesman, living in outer Melbourne. He had worked his whole life, saved carefully, and retired with around $300,000 sitting in a term deposit and a savings account. He was receiving the senior pension, not the full amount, a reduced part pension, and he had always assumed that was just how it worked, that his savings meant he got less. He accepted it and moved on. Then his daughter watched one of my videos. She called him that same evening. They sat down together and worked through his numbers, and they discovered that Centrelink was assuming his $300,000 was earning significantly more than it actually was. The gap between the assumed income and the real income was reducing his pension by over $90 every single fortnight. Over a full year, that was more than $2,300 in pension he was not receiving, simply because of a rule he had never heard of, a rule called Deeming. Today we are going through everything you need to know about Deeming in 2026, what it is, how it works, what the current rates mean for your specific situation, and most importantly, what you can do about it right now. This is Super Centrelink AU. Let us get into it. So let us start with the basics. What is Deeming and why does it exist? When Centrelink assesses your eligibility for the senior pension and how much you receive, they apply what is called an income test. The income test looks at how much money you are earning and uses that to determine your pension payment. But here is where it gets complicated. Centrelink does not simply ask you what your savings are earning and take your word for it. Instead, they apply a fixed assumed rate of return to your financial assets. They call this assumed return your deemed income, and they use your deemed income, not your actual income, when calculating your pension. This system was originally introduced to simplify the assessment process and to prevent people from hiding income by holding assets in low-returning accounts. The idea was that if you have money, you should be investing it sensibly, and if you choose not to, Centrelink will still assume you could be earning a reasonable return. On paper, that logic made sense when interest rates were higher, when savings accounts and term deposits were returning 3, 4, 5% more, deeming rates reflected something close to reality. But when interest rates dropped dramatically and savings accounts started returning less than 1%, the deeming rates did not drop at the same speed. And that gap between reality and what Centrelink assumed became a serious and ongoing financial problem for Australian retirees. That problem has not gone away, and in 2026, it is still affecting hundreds of thousands of people. So what are the actual deeming rates right now? As of the 20th of March 2026, the deeming rates for singles are as follows. The lower deeming rate is 1.25%. This applies to the first $64,200 of your financial assets. The higher deeming rate is 3.25%. This applies to every dollar of financial assets above $64,200. For couples, the structure is the same, but the threshold is higher. The lower rate of 1.25% applies to the first $106,500 of combined financial assets. Everything above that is deemed at 3.25%. These rates are set by the Minister for Social Services. They are not automatically tied to the Reserve Bank cash rate, which means when official interest rates move, your deeming rates do not necessarily move with them. The government has discretion over when and by how much to adjust deeming rates, and historically, that adjustment has not always kept pace with real-world returns. Now let me show you exactly what these rates mean in practice, because this is where it gets very real very quickly. Example 1. You are a single retiree with $100,000 in a savings account earning 1% interest. Your actual annual income from that account is $1,000, about $38.50 per fortnight. But here is what Centrelink calculates. The first $64,200 is deemed at 1.25%. That gives assumed annual income of $802.50. The remaining $35,800 is deemed at 3.25%. That gives assumed annual income of $1,163.50. Total deemed income, $1,966 per year. Approximately $75.60 per fortnight. Your actual income, $38.50 per fortnight. Centrelink is counting $75.60. You are actually receiving $38.50. That gap of $37 per fortnight reduces your senior pension by $18.50 per fortnight under the 50 cents in the dollar reduction rule. That is $481 per year in pension you are not receiving because of the difference between what your money is actually earning and what Centrelink assumes. Example 2. You are a single homeowner with $350,000 spread across a term deposit and a savings account. The first $64,200 is deemed at 1.25%, $802.50 per year. The remaining $285,800 is deemed at 3.25% RONs, $9,288.50 per year. Total deemed income, $10,091 per year, approximately $388 per fortnight. Your income-free area as a single pensioner is $218 per fortnight. Your deemed income exceeds your free area by $170 per fortnight. Under the income test, your pension reduces by 50 cents for every dollar above the free area. So your pension reduces by $85 per fortnight. That is $2,210 per year in pension reduction, simply because of deeming, regardless of what your money is actually earning. Now let me be very clear about something. Deeming does not mean you lose your pension entirely. In most cases, it means your pension is reduced, sometimes significantly, sometimes modestly, depending on your total financial assets and what they are actually earning compared to the deeming rates. But the reduction is real, it is ongoing, and it compounds over time. Robert C., the man I mentioned at the start of this video, was losing over $2,300 per year. Over 5 years, that is more than $11,500. Over 10 years, more than $23,000. All because of a rule he had never heard of. Now let me explain which financial assets are actually subject to deeming. Because not everything counts, and this is an area where people often get confused. Financial assets that are subject to deeming include bank accounts of all types, savings accounts, transaction accounts, term deposits, and offset accounts. They include shares listed on the Australian Securities Exchange. They include managed funds, exchange-traded funds, and investment trusts. They include superannuation accounts if you are over pension age. They include cash holdings and loans you have made to other people or entities. Financial assets that are not subject to deeming include your family home, your car and personal belongings, funeral bonds up to the allowable limit, certain types of income stream products and annuities, and some other specific categories. Understanding which of your assets are deemed and which are not is the starting point for understanding how deeming is affecting your specific situation. Now let us talk about what you can actually do, because understanding the problem is only useful if it leads to action. The first and most important thing you can do right now is find out exactly what information Centrelink currently has on record about your financial assets. Log into your MyGov account, go to your Centrelink profile, check your income and assets details. Make sure everything is accurate, current, and complete. This matters more than most people realize, because Centrelink does not automatically update your financial asset details when your savings balance changes. If your savings have reduced because you have been drawing them down to cover living expenses, because you made a large purchase, because you paid for medical treatment or home repairs, Centrelink may still be calculating your deemed income based on a higher balance than you currently hold. A lower balance means lower deemed income. Lower deemed income means a higher pension payment. But Centrelink will not make that adjustment unless you tell them your balance has changed. Reporting a reduction in your financial assets to Centrelink promptly can result in an immediate increase in your pension payment. This is one of the simplest and most overlooked ways to make sure you are receiving what you are entitled to. The second thing to understand is that the type of financial products you hold can matter under deeming rules. Certain financial products are treated differently. Some income stream products, for example, are assessed differently from standard bank accounts or shares. This is an area where speaking with a financial advisor who specializes in Centrelink and retirement planning can make a genuine difference. Not because there are tricks or loopholes, but because understanding how different products interact with deeming rules allows you to make informed decisions about how you structure your retirement finances. The cost of one professional consultation could be repaid many times over in pension entitlements you were not previously receiving. The third thing is to understand the interaction between deeming and the assets test. Because both tests apply to your pension calculation and Centrelink uses whichever one produces the lower pension amount. Sometimes people focus entirely on deeming and the income test to be without realizing that their assets test result is actually producing an even lower pension calculation. In that case, reducing your deemed income would not actually change your pension, because the assets test is the binding constraint. Understanding which test is actually limiting your pension and by how much and is essential before making any financial decisions. A financial advisor or an online pension calculator can help you work this out. Now, I want to talk about a situation that does not get nearly enough attention, and that is what happens to deeming when one spouse passes away. When a partner dies, the surviving spouse moves from couple pension rates to single pension rates. That transition alone reduces their fortnightly income significantly. The combined couple payment drops to a single payment. But on top of that, if the deceased spouse had financial assets that now transfer to the surviving partner, the surviving partner's total financial assets increase, and a higher asset balance means higher deemed income, and higher deemed income means a lower pension. So at exactly the moment when the surviving spouse's pension income drops, because they are moving to single rates, their deemed income may also be increasing because they have inherited their partner's financial assets. These two things happening simultaneously can create a significant and sudden reduction in financial security at the worst possible time. If you have recently lost a spouse, or if you are planning your finances with this possibility in mind, understanding this interaction is critically important, and acting quickly to report any changes in your financial situation to Centrelink is essential. Let me also quickly cover Commonwealth Seniors health card holders, because deeming affects you even if you are not receiving the senior pension. The Commonwealth Seniors health card provides access to cheaper medicines through the Pharmaceutical Benefits Scheme and a range of other concessions. Eligibility is assessed based on your adjusted taxable income, and deemed income from financial assets is included in that calculation. So if you hold a Commonwealth Seniors health card, or if you are thinking about applying for one, changes in your financial assets or changes in the deeming rates can affect whether you remain eligible or whether you qualify. Many Australians who do not receive the senior pension because their assets or income are too high do qualify for the Commonwealth Seniors health card, and the concessions it provides can be genuinely valuable. But you need to understand how deeming affects your adjusted taxable income to know where you stand. Now let me give you a clear action list to take away from today. The first action, log in to MyGov right now and check what financial assets Centrelink has on record for you. Make sure the information is accurate and up to date. The second action, calculate your own deemed income using the current rates. 1.25% on the first $64,200, 3.25% on everything above that. Compare that to what your money is actually earning. The gap between those two numbers is the source of any pension reduction from deeming. The third action, if your financial assets have reduced since you last updated Centrelink, report the change immediately. A lower balance means lower deemed income and potentially a higher pension. Do not wait. Report it now. The fourth action, if your financial situation is complex, if you have recently lost a spouse, or if you are approaching pension age and trying to plan ahead, speak with a licensed financial advisor who specializes in Centrelink entitlements. The investment in professional advice can return many times its cost in pension entitlements properly claimed. The fifth action, stay informed. Deeming rates are set by the government and they change. When they change, your pension entitlement changes too. Subscribe to this channel so you always know when something changes that affects your payment. Robert eventually sorted out his situation. He updated his asset details with Centrelink. He spoke with a financial advisor. He started receiving a higher pension payment, not dramatically higher, but meaningfully higher, enough to cover his monthly grocery bill with room to spare. He said to me, "I wish I had known about this years ago." And that is exactly the point. The rule was always there. The impact was always there. He just did not know to look for it. Now you do. If this video helped you understand deeming and what it could mean for your senior pension in 2026, please hit the like button right now. It genuinely helps this channel reach more Australian retirees who need this information. Subscribe to Super Centrelink AU so you never miss an update on pension rules, Centrelink changes, and everything Australian seniors need to know to protect their income and their independence. Drop a comment below and tell us, did you know about deeming before watching this video? I read every single comment and your questions shape the videos we make next. And please share this with someone you know who is retired or approaching retirement, because this rule could be quietly reducing their pension right now and they may have no idea. I will see you in the next one.